one of the things that makes it so difficult is we're not really built to withstand the 77R losing streak. That's not the way we operate.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to Two Traders Podcast. Hello, Darren.
Good morning, Walter.
Well, so the topic we had discussed for today was this idea of prediction and whether or not, as a trader who's looking to pull profits out of the markets, whether or not you have to have some way of predicting the markets. I think this is a really interesting topic, and I think I know what you're going to say, but what are your thoughts on this issue? Because I think it's kind of assumed, like people who are new to trading or don't know much about trading assume that what you do as a trader is you predict where the markets are going to go. So what do you have to say about that?
Yeah, I think that is definitely the approach that I'm going to say the majority use. The majority that I come into contact with definitely have that sort of approach. And I don't think obviously you don't need to be able to predict the market, but maybe as human beings, we have to have that belief that that's what you're doing, even if you're not, if that makes any sense. Because the opportunity lies in the movement of price. You don't necessarily have to be right about where the direction's going to go to make profit. And I saw that recently. Just yesterday, one of the members of the forum ran a test on a really simple trend trading idea that I had posted a few months back. And he did 10 years of testing on this strategy, and he found out that it had a positive expectancy. And, I'm always saying that you don't really need to predict the market. You just need to participate and maximize your profits when you're right and minimize your losses when you're wrong. So what he did was rather than using the simple rule that I had for determining the trend, he just determined the trend for the day by using essentially a coin flip. But obviously he programmed it so it was either long or short. That decision was made randomly every day, and he actually made more profit. And quite a bit more profit. So you have to start to sort of question, okay, well, why did it make profit? And in this instance, you can't prove why it made profit. There's a few elements working together, but the core of the strategy idea is that you hold your winners for a long time. So in his test, he was using a risk to reward of 5-1. So he's winning 5 times more on his winners than he was on his losers. So, the obvious assumption to make is that, predicting the market direction isn't essential. It's the fact that the market does actually move, because for a 5-1 you need the market to move in one direction for quite a sustained period.
Or you could have a really tight stop, right? Like you could have a 5-1 winner if you have a 6 pip stop and you just get 30 pips out of the market, right? That's potentially, yeah. Yeah, essentially, yeah.
So it's that drift, it's that movement from A to B, and B being not where A was, essentially.
Yeah.
So you don't have to be able to predict the market. But if you kind of go a little bit deeper into the psychology of it, I think, there is kind of a subtle advantage for us to believe we are. Even if deep down it's not essential for you to do it, I think sometimes it's quite helpful to put those things in there where you believe you're kind of having some effect on the outcome. So it's a difficult one to say, and there might well be people out there that can, by their sort of gut and years of experience of looking at charts, have like a good hit rate of predicting where the market will go. As the test has shown, it's not essential.
Right. So just playing devil's advocate here, did he run just one test of the random long short? So he had the computer determine whether it was a long day to buy or a short day to sell, right? So, but he only ran one test. So someone could argue that, well, he just got lucky. He kind of lucked into a sequence of long and short days with the random generator that, you know what I mean?
No, he ran the test for 10 years and then he ran it 10 times.
Right. Okay. So 10 sequences of buy and sell days.
Yes. Yeah. And his lowest return was 215R,
right,
for the 10-year period, and his highest return was 614R.
Right.
So it won in every year. Now that could still just have been pure luck.
Yeah, because some people would say, well, you got to run a Monte Carlo with 10,000, sequences or whatever. I mean, blah blah blah. Yeah.
But then when you back it up with the trend rule in place also being profitable, then your gut has got to start telling you that the probabilities are it's the high risk to reward and the market condition that existed during those 10 years.
Yeah, absolutely.
And you'd have to say, well, was there something specifically unusual in those 10 years of market movement, or are they generally what the market always has done? So you have to kind of dig a little bit deeper.
Absolutely. Yes. Yeah, that's interesting. So what do you think that's what it is? I mean, do you think that the reason why those 10 tests over 10 years made money was because the market was basically moving? I mean, if the market was pretty, if the market had consolidated, in which market did he trade it on?
It was the euro yen,
right?
And he was trading the 1 hour chart.
1 hour chart, right?
He did do tests with different risk to rewards as well, but that was only with the predetermined direction indicator, whatever, the trend indicator in place, from 2R all the way up to 10R, and all of those were profitable. For me, it's about the drift of the market. For me, it's about the fact that the market
wiggles. It wiggles around.
Yeah, wiggles. Yeah, it wiggles, and it has this kind of drift. So it will stay in a range, but then it will move onto a different range, and so there's opportunity there in that movement.
Yeah, absolutely. Yeah.
I mean, obviously, if price just stayed in a range forever, then it would be simple, wouldn't it? Likewise, if it just trended forever, it would be simple.
Yeah, absolutely. Yeah. It reminds me of, what the concept that you're talking about right now reminds me of what Gonzalo said at the conference. He was talking about this strategy of, he looks at drawdowns in a completely different way, the way that he trades. He was saying that, the idea is that if you look at the coastline of, say, Massachusetts, you could measure it one way and say, oh, well, it's a 300-mile coastline or something like that. But if you zoom in at it and you zoom in and see all the zigs and zags, it approaches infinity with all the little moves. And so the question is, how, do you want to take advantage of those little tiny how much do you want to zoom in and zoom out? You know what I mean?
Yeah.
I mean, isn't that kind of the way you trade? If you're trading a 1 hour chart and you're trading the zigs and the zags in the 1 hour chart, that's a completely different experience to trading the daily zigs and zags.
Yeah. In time, definitely. Yeah.
Yeah, absolutely. Yeah. Because remind me when you were talking about the way that you approached this strategy originally before he used the random entry or the random determination of bullish days and bearish days, how did you determine whether the day was bullish or bearish? What was your indicator for that or whatever? What was your approach?
Just really simple. It was if the previous day closed bearish, so it was down on the close was down on the open, then the next day you trade only short. And if the previous day closed bullish, then the next day you only traded long. And the whole point of putting the strategy forward was to say, look, we're debating too much about how to determine the direction to. We're giving too much emphasis on picking the direction, because we're being led to want to be right and to be right because of, how clever we were. Look how learned I am, and I could predict which way the market was going to go. And I was just trying to say, well, look, it's actually really difficult to do that. And moreover, you don't actually have to be able to do that. So simplify that And when you adopt that mindset, then you'll find it easier to stick at a strategy over a long period. And in all of these tests that he did, if you just took 1 month of the trading, you probably wouldn't have made any money in any of them. But because he stuck at it for a long time, the numbers were allowed to play out, and that's where he made really good returns. I mean, people will argue that 200R over 10 years is not enough, but 20% a year compounded is amazing results.
Yeah, especially if you don't pull money out of your account. Yeah, exactly. If you compound it, yeah, and also remember that the R that you had, the R that you returned on year 1 is obviously completely different than the R that you return on day or year 9. I mean, it's completely different. It's a completely different result because the account's grown. Yeah, that's compounding. Yeah, I think a lot of traders miss that. So let me ask you this: do you think that the reason why, because you sort of just touched on this, do you think that the reason why this 5R strategy with a random assignment of bullish and bearish days, do you think that the reason why it makes money is because it was given such a long period of time? Because in other words, if he had traded this, even if it was the 1 hour chart, for only 30 trading days, he could have there's likely, or perhaps he could have just thrown it away and said, this is no good after looking at those results.
Yeah, I think, I don't think the reason it made profit is because it was traded for a long period of time, but it is quite likely, the wins and the losses are pretty randomly distributed, and it is quite likely you could start and just lose all month. There was very long sequences of losses. I think the 10R strategy had 77 consecutive losses, but it made 600 odd R at the end of the trading period. And I think again that's what draws people to say no, I've got to improve at predicting, because this cannot be right. This isn't right. But that's the nature of trading. I mean, if you don't learn to deal with those elements of pain, then I don't think you can make it.
That's great. Yeah, that's great advice. I mean, that kind of boils down. So when you look at trading, the trader who is able to somehow come to a place where he or she can deal with 77 losers in a row, 77 R loss, can live to see the day of the 600 R win, right? I mean, a cumulative win. But the trader who cannot do that, the trader who completely scraps the system after 3 losing trades in a row, never lives to see the day of the 600 R payoff. And I would even say one of the things that makes it so difficult is we're not really built to withstand the 77 R losing streak. That's not the way we operate.
Yeah, and that's why experienced traders are always saying psychology, because they know that you're going to have to deal with this hurdle at some point. If you're going to make it, at some point, this is a barrier you're going to have to cross. Even the 2R test had 19 consecutive losers, okay? Even the 2R, and it made 193 R at the end of the test period. Your mind is going to say to you, okay, I need to improve this strategy to get rid of this element, consecutive losers, drawdown, or whatever. And it's almost impossible to do. So, a better approach is to accept it and say, right, this, I've accepted this now. And then when the moment comes that you hit this losing streak, then, you've at least got a chance of sticking with your strategy. And I presume that the majority don't do that, and that's why the majority, don't make profit.
Yeah, that's right. Yeah, because they take quick profit. Basically, they like really quick, short, in and out sort of profits. Yeah. So when we know that from the data, I think you posted one of those things in the forum, the article about where they had looked at millions of trades, and that's basically what they found that most traders take quick profits. They're right more often than they're wrong, but their losers are so big it wipes out their profits. So let me ask you this, Darren. If someone's listening to this and they say, wow, that sounds really cool, I want to do something like that. First of all, we've given you everything you need to know, right? It's not very difficult. You can create a strategy based on what we said here. You could test a strategy where it was 5R, and you're basically flipping a coin whether you're going to go long or short. Now, you're probably going to have to mess around with your stop loss placements and all that, because that's I don't know what kind of stop loss did he use? Was he using like a 60 pip stop or something like that, or
no? He was.
Oh, it was a 1 hour chart.
It was a 1 hour chart, and if the direction for the day was short to sell, then if you had a bearish close on the 1 hour time frame, you took a sell at the low and put your stop loss at the high
of the 1 hour candle, right? Yeah.
And that was it. So there was no particular candle pattern. There was no moving averages. If a bar closed down, that was a sell signal. You put a sell at.
And he didn't care if it was a 70 pip candle or a 15 pip candle. It was just
no difference. Yeah.
Right. Yeah. Yeah. That's interesting.
So really simple. I mean, it's literally taken away all of the analysis, and just it is essentially just a risk to reward strategy. Basically.
Yeah. I mean, I think a lot of like the way that the turtles originally traded was kind of like that. If it makes a 55 period high, you go long or whatever, and you just wait until it makes a 10 period low and then you sell out. Like that's your trailing exit. I mean, there's really no guessing involved. Like you don't have to know whether sugar is going to go up or sugar is going to go down, sort of thing. Yeah.
Yeah. And that Done Capital guy has traded a system like this for decades.
Yeah, I knew you were going to... I had this running bet in my head whether or not Done Capital would come up. I knew they would come up because but it's a great example of this. It's a great example of this.
Yeah. Because he does no analysis at all. He doesn't look at sugar and look at the fundamentals and look at a chart pattern.
Yeah.
If the moving average crosses over, he goes long and he holds it. If it crosses back again, he goes short and he holds it.
Yeah. And he's always in the market.
He has long periods of losing, but then he gets like a massive winner. And, that's an extreme example, And then there's Basso, who did a completely random entry. Tom Basso, yeah.
Tom Basso.
A completely random entry and used a wide stop and then a trailing system. So... again, he'd have lots of losers, and eventually he's going to get the trades that run. It's one approach, and I'm not saying you have to trade this way. If you want to still trade in an analytical way, just take these elements on board, because they can also improve that style of trading.
Yeah, and it just opens up your mind and it can give you a relief. Like I have a lot of friends, I have some friends who are retired and they're really more investors than traders, but we talk about the way that they trade or invest, and they ask me questions as well. And what's interesting is they look at me and and say, wow, I can't believe you do what you do because you must have to read all the newspapers. And I explained to them, no, actually no. Reading the newspapers is the last thing I want to do. It gets in the way. But people assume that. They think that that's the way that you know what's going on. That's the way that you know whether to go long or short is by reading the newspapers. Well, that's, it gets in the way. So I think a lot of people listening to this, even if you don't want to trade this way, what you can take away from this is obviously, look, the key things I need to be looking at here are dealing with my emotions and how am I able to withstand huge drawdowns, huge losing periods, and two, how can I set up my trading so that I'm going for large reward to risk? Because if I'm going for large reward to risk, I can really be kind of sloppy, with my trading and still make money. I know that might not sound right and that may not be taken the right way, but you can kind of mess it up. You can kind of mess your trades up and still make money if you have large reward to risk ratio.
Yeah, I think the further you go down this idea of being able to predict or wanting to predict everything, you get into such minute detail about exactly the right setup and exactly where to place the entry and the stop, and before you know it, you can't take any trades at all because you've basically built so many criteria that you're actually never in the market, and I know overtrading's a problem, but if you never enter, you're not going to win anything either.
Yeah, that's right. Yeah.
I think, also a friend of mine recently sort of reminded me about, over Christmas he said he reread some books, and he reread Nassim Taleb's Fooled by Randomness. And, if people have never read that book, it's a really good book for just kind of making you, think about things slightly differently in terms of trading anyway.
Yeah, absolutely. Absolutely. I think he consults for private funds or something like that. Yeah. The interesting thing about the way that he trades is it's completely different to the way his mentor trade. His mentor sort of just took the short, quick profits, and he trades the exact opposite of that. Yeah.
Yeah. That can be a really good edge as well. I mean, having a high win rate can be a good edge. The psychological pressures are slightly different with that, in as such as you tend to stay around break even for a long time, and the increase in your account is very slow. But you can use that approach as well.
Yeah, absolutely.
That's all the time we have for this episode. In the next episode, we are going to dig into palm readers, the trader who could never lose, what it means to predict the future and be human at the same time. All this and more, including the hive mind, in the next episode of the Two Traders Podcast. I'll see you there.